Hello and welcome to Capital Market Live on Channels Television. I'm Will Ibang, and as always, let's check in on the markets. We begin with Europe, where stocks closed sharply higher on Friday to end a volatile week as investors around the world assessed inflation and fears of an economic recession. Major markets recorded triple-digit gains. France's CAC 40 rose 3.23%. The German DAX edged up 1.59%, while the UK's FTSE 100 rose by 2.68%. Central banks last week made aggressive moves to rein in inflation, and investors are now hopeful that rising consumer prices will be brought under control as commodity prices, notably oil and economic output bellwether copper, pulled back sharply in recent days. Now, shares in Asia Pacific were high on Friday as well, led by tech stocks on the Hong Kong market. Hong Kong's Hang Seng Index jumped 2.09% to close at 21,719.06 points, with the Hang Seng Tech Index rising 4.05%. In Japan markets, the Nikkei 225 advanced 1.23% to close. Also, mainland Chinese markets rose. The Shanghai Composite gained 0.89%, and the Shenzhen Component was 1.36% higher. Over to the U.S., where the Dow Jones Industrial Average rallied more than 800 points on Friday, rebounding off the lows of the bear market last week and capping its first weekly gain since May. The Dow rose 2.68%. The S&P 500 was 3.06% higher, while the Nasdaq Composite advanced 3.34%. The major averages wrapped up a big comeback week for stocks. The S&P 500 is up nearly 6.5% for the week, while the Nasdaq Composite gains 7.5%. The Dow is 5.4% higher. Those moves followed the worst week decline for the S&P 500 since 2020. Now back home, losses recorded in the shares of heavyweight cement companies Dangote Cement and Boa Cement on the first trading day of the week offset the cumulative gains of 1.9% week to date. This led the local boss to suffer his second consecutive weekly loss. As a result, the all-share index declined slightly by 0.14% week on week to close at 51,705.61 points. Profit-taking activities in Boa Cement, Dangote Cement, Nigerian Breweries and Lafarge led the weekly loss. The month-to-date loss and year-to-date gains settled at 2.4% and 21% respectively. However, activity levels were stronger than the previous week as the trading volume and value increased by 19.1% and 19.2% week on week. Now analyzing by sectors, we see that the consumer goods, industrial goods, insurance indexes declined while the banking and oil and gas indexes advanced. Nigerian Aviation Handling Company, that's NACO, topped the gainers chart for the week, while CWG PLC led the decliners. The trio of FCMB, UBA, and Oando contributed 36.39% and 14.66% to the total volume and value traded in the week. Meanwhile, the NASD OTC Securities Exchange Index closed the week on a positive note. The NASD Securities Index rose by 0.5%, with investors gaining about 1 billion naira. However, volume traded fell by 57% to 2.6 million units, while value rose by over 300% to 324.37 million naira. Niger Delta Exploration and Production led two other gainers for the week, while NASD PLC led the decline in stocks. VFD PLC and Central Securities Clearing System were the top stocks traded by volume this week. Now, joining me to review the activities in the equities markets in general is Oluwaseun Dosunmu, Head Investment Research at Parthian Securities Limited. Good to speak to you, Seun.
Thank you.
Now, Seun, the stock market experienced a whipsaw effect this week, especially in June, losing the resistance levels it has achieved so far. Now, give us a deep dive behind this week's market performance.
Okay, thank you for that. Like you mentioned earlier, the performance on Monday was actually bad, and that was due to the decline in the performance or the price of Dangote Cement. I mean, Dangote Cement declined by 10%, and we know that Dangote Cement is part of the largely capitalized stock, or is the largest capitalized stock on the exchange. So a 10% decline definitely hit the market. We saw that the performance on Monday actually declined by 1.97%. And throughout the week, even though we saw the positive move from Tuesday till Friday, that was still not sufficient enough to, pull the market to the positive. However, we've seen that, the month of June, the performance of the markets in the month of June hasn't been exceptional. And it's not surprising. I mean, we've seen the positive run that has occurred since the beginning of the year. And right now, cautious trading is what I think most investors are doing, because we've seen that the market actually, the year-to-date return actually hit about 24%. And when the news broke about the CBN, the Monetary Policy Committee now, hiking the monetary policy rates to 13% from 11.5%, we saw the knee-jerk reaction, whereby investors decided to, start to reduce their exposure in the equity space and now flow, back into the fixed income market. However, we know that, the equities market still provides positive real return. So we've been seeing that despite the hike in interest rates, investors are still in the equity space. We've seen that, prices generally has increased. Even the performance during the first quarter of the year was quite good. Investors responded positively to that. Also, we saw that the dividends, the corporate announcement dividends that were declared during the first quarter of the year were also quite good. It was better than what we saw in previous years. So investors reacted positively to that. We've also seen that, due to that and the fact that, crude oil prices have been on the upturn, the market has been largely driven by domestic players, domestic institutional players. That has been pushing the market. So it's not surprising to see that, there was a mild pullback in the market. There's something we always say, the market does not move in a straight line. So this pullback is not surprising. It's not surprising, actually, because, like I said, the market doesn't move in a straight line. Investors are bound to take profit at some point. Okay. So we are seeing that come into play. And let's not also forget that, we have the political climb. We also have the fact that, the Monetary Policy Committee decided to hike interest rates. Investors were a bit spooked by that. However, one of the things that people are now looking at...
Let me just cut you in there. Okay. You mentioned that the market is filled like domestic investors are the one dominating the market at the moment. Do you see any point in time where foreign investors are going to come in, have a say in the market, possibly bring in some forex into the equity space?
At the moment, I don't think so, and the reason is because the major reason why they left our market had to do with, the FX translation losses. That's the issue with FX translation losses they had, especially the fact that it was heightened in 2019. That issue has not been resolved. It just means that foreign investors would come into our market at a particular exchange rate, and when it's time for them to exit our markets, they also leave at a higher exchange rate. So the gains that they've actually made in the markets is watered down. It's being lost by, FX translation losses. So investors decided to stay back with the expectation or with the hope that, something will be done about it. And since nothing has been done, they've decided to stay away from the markets. Also, let's not forget that, in the global space, we've been seeing that most central banks have been hiking interest rates, especially in the US. We've seen that, the interest rates has actually increased to between 1.5% and 1.75%. Yeah. That is not good for emerging markets. It just means that foreign investors are going to move their funds from emerging markets back to their home country. So even if, what's it called now, exchange rate regime has been adjusted, we still have seen, them move out of the market. Same thing with the political climb. This is a pre-election year. Every pre-election year, based on historicals, foreign investors always, pull out of our markets and wait for the dust to settle before they come back into our market. So right now, they are not. I don't think, or we don't expect them to come back into our market until there's some form of traction in terms of our FX translation. In terms of our exchange rate, sorry. Okay. In terms of our exchange rate, I believe that once we start to see some form of stability in the exchange rate regime, they will most likely come back to our markets.
Okay, so other things that happened, we saw Oando finally released this 2019 and 2020 unaudited interim financial statements. After 2 years of dispute with the Securities and Exchange Commission, it was disappointing. What are your thoughts?
Yeah, so before now, we were actually looking forward to, Oando and SEC resolving the disputes. And when that happened, everybody was happy, especially that happened in July 2021. Everybody was, people were happy about that. Investors were happy about that with the expectation that, by the time we start to see Oando's numbers come in, it'll be impressive. However, when their numbers actually were being released, it was rather disappointing, like you said, because we saw that their performance generally in 2019 was not good at all. Now, if you back up a bit and look at their performance in 2018, you would actually see that their result was good. But from 2019, when the dispute started, even from the share price, you will see that the share price started to decline from around 4 naira. It declined to as low as 1 naira 89 kobo. And from that time, the price has just been ranging. So when their results came out, it was rather disappointing, like you mentioned. We anticipated that their numbers would actually at least compensate for that issue, that period of time when their results were not released. But the results came in, and a lot of investors were disappointed. We were all disappointed. We saw that there were major losses in the numbers. Now
speaking of disappointing investors, you see that the company seems to have lost investors' confidence, seeing that minority shareholders are about to stage a walkout. They're looking for majority shareholders to buy them out. What's going on there? Give us more insights.
Okay, so so like I was saying, when the results were released, we saw that definitely Oando was affected by what happened in 2020. As with other oil companies, crude oil prices were actually declining. In 2020 alone, crude oil price actually declined by 45%. Gas prices declined by 24%. With these figures that have been coming out, we saw that minority shareholders decided to opt in for them to be bought out. So we saw that minority shareholders decided that, okay, you know what, with what is happening right now, and with the fact that, the company is not even, providing some form of assurance for investors. So they decided that, let the major shareholders buy the minority shareholders. So minority shareholders occupy about, I think, 43% of the shareholdings for Oando. And with that, we've been seeing that tussle. We even saw that Oando is considering, or they might consider, delisting from the exchange. That is not good. And because the minority shareholders are the one pushing for this, we would see that I don't expect the majority shareholders to buy the minority shareholders at a premium, or buy the shares at a premium. So for those investors that are currently in that space, I think that one of the good options, or one of the smart things to do, is just to cut, your losses and just exit and position somewhere else, whereby you can benefit from, capital gains and even from dividends. So right now, the case with Oando is not looking too pretty. It's not looking too pretty, and we just expect that, things kind of resolve the issue. I don't know how this issue might be resolved, but I think going forward, that's one of the things that everybody will be looking at. For those who still believe in the company, those still believe that, because if you look at their performance during 2019 till 2021, there are some positives. In terms of their production increased. In terms of the number of barrels per day, the volume of production, it actually increased. In terms of their traded volume, that also increased by at least 13%.
So maize inflation figure was at 17.71%. It jumped up from 16.82% in April. What are the implications for equities and the fixed income market?
Okay, so with those numbers coming in, it's not surprising. because generally we've been seeing that, there's been a lot of pressure, especially on consumers' wallets. Part of the implications to that is that we might see reduced volume and value of transactions, especially from retail investors, because now consumers' wallets are pressured. Investors' disposable income would actually be lower, which just means that the amount that or the level of the amount that they would actually invest in the market would actually be lower than what it was before. However, the equities market still is the place to be when it comes to positive real returns, because that's the only investment option that would give you positive real returns. For the fixed income markets, we're seeing that the increase in inflation is actually not good for the fixed income market, because it means that your real return it will be negative, because we're still seeing that treasury bills are the yields in the treasury bills markets are still low, even though they will be higher due to the monetary policy committee's decision to hike the monetary policy rates at their last meeting to 13%. It just means that, first of all, we're going to see that the yields will start to increase, because the yields in the fixed income market will start to increase. So generally, when inflation hits like this, we tend to see, in some cases, we tend to see that the level of investments in the market actually reduces. Now, what would actually spur investor sentiment or drive people to actually invest would actually be the return. And the equities markets, based on the companies or based on the sector that investors are actually looking at, that would actually determine the kind of return that investors will get in the long term. So if one might think, okay, so what sectors would likely give us this kind of return? Like the telco sector now has been doing quite well. We've been seeing that there's a lot of prospect for that sector. We know that the telcos receive the PSB license, the Payment Service Bank license, which gives them the opportunity to operate as a bank. So that is good for the telcos. It just means that more revenue, there will be more financial inclusion, and which just means more activities for them. So we would see investors now focus on those sectors that would most likely give them positive real return. Okay. We know that what's it called now? Data has been doing quite well. We also know that the what's it called now? Mobile penetration has also increased. Based on the NCC's last report, we've seen that mobile penetration has also increased, which just means that more funds, more revenue for the telco. So that is an example of some of the sectors or a sector that investors will most likely look at going forward. Because
so we do know, as you mentioned, that some asset classes tend to perform better during higher inflation periods. What other investment options, apart from the telcos, are available that will yield positive real returns? We talked about the telcos. Are there any other asset class that investors should be looking at?
I think for us, we have a preference for, the equities markets, because there's actually a dearth of investment options, especially for a regulated market. You have the fixed income market, you have the, equities markets, then you have, other alternative investments. But when it comes to, that focus on which markets would give you that positive real return based on historical performance, based on historical trends, it's still the equities market. Because of that, that insufficient or that scarce alternative in terms of investment options, we will still see some, investors take take positions in the equities market. Because let's not forget that for the equities market, the two major reasons why people would invest there is because of capital appreciation and dividend payments. And in terms of capital appreciation, most of the companies have been doing quite well, as we've seen in their first quarter results. They've been doing quite well, especially with the fact that most of these companies are moving back to the pre-COVID levels. When COVID hit in 2020, a lot of companies were impacted, and they didn't recover immediately. That's in 2021. So now we are seeing a lot of companies do better than before. Prices are even much higher than what they used to be. So even though, yes, I mean, inflation is hitting and most of these companies can't pass on that cost to the final consumers, some of them have to take on that burden. But still, we're seeing that companies' performance generally have been much better than what it used to be. So going forward, one of the things that will come to people's minds is that, like I mentioned, even though we're seeing this, what's it called now, this hike in interest rates or hike in the monetary policy rates, yes, we would see that more investors will tend to move to the fixed income markets because it's more secure. I mean, the principal and your principal is guaranteed. However, there's still we are optimistic to an extent that we'll still see a lot of participation in the equity space because now we're already close to the end of the first half of the year. We're going to see companies start to declare interim dividend. Now we're going to see investors take advantage of that, corporate action. So the move now is to focus on those companies that would actually pay, interim dividend and actually start to position in them now, because by the time we start to see their results, by the time we start to, get the corporate announcements of these companies that have declared dividend, you would definitely see a corresponding increase or move in their prices. So right now,
maybe if we want to get a bit, Seun, maybe we want to get a bit more specific here in terms of the companies that investors should be looking out for, because this period, investors are wondering where they really should put their money. Asset classes, I want to mention, you talked about your preference for equities. We would look at oil and gold in inflationary periods. They have had a record. Studies have shown that they have, improved. The performances have improved, during inflation periods. Don't you advise investors to put their money in those asset classes?
Oh yes, I mean commodities too. I mean, have been doing quite well. We've seen that commodity prices have actually improved. We have gold, we have natural gas, we also have oil palm. I mean, oil palm has done remarkably well, and that is due to the fact that Indonesia decided to reduce their export of oil palm. As such, we've seen that the companies that play in that space in Nigeria, Okumu Oil and Presco, have done very well because part of their output have been exported, have been sold, outside the shores of the country. So we've seen that, those companies too have been doing quite well. I mean, one of the reasons why, we don't lay a lot of emphasis on commodities, especially, for gold and other commodities is just because basically you can't invest directly in them. You need to go through an exchange, a commodities exchange, and is also subjected to, the exchange rates, which just means that, we're back to that same issue of the the exchange rate issue. So that's why we still always recommend that, if most investors that have, Naira obligations still focus on, the domestic equities markets, because for those that have Naira obligations, that is the only way, or that is the most preferred way to actually have, positive real returns on your funds. What do I mean by positive real returns? I mean, if you calculate what your return is and subtract the current inflation from that figure, then that gives you what your positive real return is. I mean, if you look at the fixed income markets, I mean, we know that yields for the bond space is about 11%. So if you say 11% minus the 17% in inflation, we can see that the real return is negative. Now, for the equities markets, if you focus like you asked, what companies? I mean, we would recommend that investors focus in the telco space. For some, for banking space, and also the commodity link space. And also the consumer goods space, because we've seen that, especially for the brewers now, we've seen that their numbers has actually rebounded from what it was in the previous years. So those are the sectors that we'll most likely recommend.
Okay, so the second half of the year is around the corner. Just give us a quick one. What's your outlook for the equities market in the next half of the year that we're coming into?
Okay, so looking at the second half of the year, we recommend cautious trading, and that is because there are some key drivers to look at. First of all, we know that when it comes to investor participation in the markets, investor participation is still tilted more to the domestic players or in favor of the domestic players. So we have more domestic players playing in the markets, which is actually good. Secondly, we need to look at the interest rate environment. The interest rate environment is much higher, which just means that which just means that domestic investors would most likely prefer, because of the current political climate, they'll most likely prefer to secure their principal and stick to the fixed income markets. So these are part of the things that would dictate the direction of the market during the second half of the year.
Okay,
However, we would also like to.
Oluwaseun, Dosunmu, Head Investment Research Partners Securities Limited. Thanks for sharing your thoughts and your insights with us this evening.
Thank you.
And that's it on Capital Markets. To join us same time next week, I'm Willie Bong. Thanks for watching.